I'll just do a quick introduction for everyone. Kat, are you going to join us? Yes? Anne? Anne? No? Not feeling it? Okay, all right. So I'll just do a quick introduction and then we'll get into the questions for everyone because she's just walking up on stage. Anne, career banker with Stanbic Bank, who refuses to play golf with me. She is at the intersection where she decides, where capital flows and where also it doesn't flow, typically in my direction. So thank you for that, Anne. But if you're in real estate, you know Anne very well. Then we've got Kavita Doshi, managing director at Innova, fitness expert. Also recently was recognized by the African Chamber of Business as a women leader of excellence. So congratulations for that. Next, we've got Timbo, CEO of Batian. Batian is a property fund that is backed by Gen Africa, asset managers. They manage approximately, Timothy, if I get it wrong, please don't correct me, about $5.5 billion of assets under management. So for the developers here, you know whose hand you have to shake at the end of this. And then last but not in any way least is Solomon. Solomon, as we've heard, recently led the management-led exit of the original investors of Vida Homes, very path-defining transaction. Congratulations to yourself and Sam for that fantastic achievement. So what we're going to try and solve for in this panel is essentially we're going to be looking for the answer to whether real estate sector in East Africa has been able to mature. Are we now moving to that institutional phase that seems to be a key theme behind this conference? I'm going to start with Anne first. Anne, as the banker, usually banks are the ones that identify economic cycles, sector cycles in advance of everyone else. Are you seeing this, let's say, change in approach where the real estate space, given the conversations, the dialogue that you have with various players, are they moving to more of an institutional way of thinking?
Good afternoon, everyone. And thanks, Raghav. Thanks, fellow panelists. I agree with the question largely in terms of do we see the trend in institutional capital chasing after real estate assets, but more importantly, are banks really at the forefront of seeing these trends? I guess by nature of how we are structured, we see, we are based across Africa. We deal with both developers, users of real estate assets, investors in different facets. So it's easy to see when the sales are turning and what do we need to do right at a point in time. So that said, to Raghav's question, do we see, is the time now? Is it a new frontier? I would say this has been going on. It's just gaining momentum now. It's just becoming a lot more prevalent. It's becoming more everyday living. Because when you think about it, institutional capital is really professionalized capital. It's from fund managers, asset managers. It's from pension funds. It's from insurance companies, large family-owned family offices. So that capital is looking for longevity of cash flow returns, sustainability of those yields. These are people that have put their long-term savings and they hope the yield will continue, the monies will be safe. So the rigor expected in managing those assets needs to be very professionalized. You can do it as a one asset owner, but you might miss the trends. You might miss what's happening globally. So that's why it is safer to work alongside an institutional investor and expect that they're looking for real estate assets where they can diversify their returns. I'll pause there.
Thanks, Anne. Kavita, I just wanted to follow on from that. Typically in emerging markets, developers are a little bit more entrepreneurial. But when they developed, it was for long-term holding because really you didn't see the patterns of institutional exits, right? Given also a recent transaction that you took part in, and we'll speak to that a little later, but has your business model shifted given the way Innova was set up and where it's maybe what it's been able to deliver in the recent past?
Oh, thank you. Thanks, Raghav, for the question. And again, thank you to fellow panelists and friends. Great to be here. So I think the answer is yes, but it is quite nuanced. You know, family offices, we have a mindset of legacy. We have a mindset of identity, which is very attached to the assets that we own and that we deliver. So historically, we have been shy to maybe step into that buy-to-exit model. And then the bigger barrier has been really around the availability of these exits and the pathway to exit. And that just hasn't been there. We haven't had many institutional capital exits that have taken place. We haven't had price discovery mechanisms in the market. We haven't had many structured REITs that have been able to kind of shoulder that. So there was a market opportunity gap as well. So the transition that I really see is, well, demand side has shown up. Tim's shown up. And we can see assets under management, I believe last year was closing towards 3 trillion shillings for pension funds in Kenya. Close to, I believe it was a 25% increase year on year. So the capital exists. And then there's a recognition of quality-led, really well-executed African real estate that can be a contender for that capital. But then we also know institutional capital is highly selective. So for those pathways to exit to really materialize, us as family offices, we need to transition our mindset into that level of quality that needs to be delivered. You talked about rigor, and we talk about quality, but what are the facets of that? That is operational excellence. That is execution on the ground, oversight. That is the efficiency that's passed on to our end users, tenants, the longevity and future-proof performance. So as family offices, and that's our focus. So when you ask me, that's where our focus has evolved to, and that is really where we hone in on how do we create assets that will endure for the long term, that provide durability, precision, that are market leading, and really deliver, whether it is built to hold or built to exit, both sides to compete, that's where we need to be. And that's the understanding that family offices like ourselves need to get to shift to meet the institutional demand that exists.
Cool. Timothy, earlier Mercy spoke about capital being available. That definitely is the case for you. And Kavita just mentioned about capital being selective. So as someone who is leading a property fund, how do you put that all together? What leads you to select between different buildings? What are you looking for as the differentiating qualities for assets?
Yeah, thank you, Raghav, and once again, thank you to everyone for the opportunity. I tend to think, so your question boils down to trying to understand how would you look at a good asset and an investable asset. So I'd like to take it a bit historically. The market has largely defined investment-grade assets based on grade A, grade B, grade C. When you think about commercial, you're largely thinking about parking ratios, floor plates, what are the criteria? Location, number of lifts, etc. There's criteria that's not certified generally, but generally agreed across the market. When you go to logistics, for example, where I think you're the leader in industrial grade A stock, you'll notice you have your eaves, your loading areas, your circulation areas, your dock levelers. So they're generally agreed parameters of what a good asset would be. But in the recent past, I believe the green certification is the quickest way to tell what a good asset would be. If you are endorsed by a green, globally certified IFC Edge LEED, there's a high chance you'll pass a corporate occupier checklist, and by extension, that will be a good asset. But it's a very good question because my view is, like I said earlier, good assets are always investable, but I don't think all investable assets are good assets. We've had a very hard time. Fundraising has been an uphill task for us. I see very many victims as well around here. And return remains a big driver in terms of investability. We have governance, we have institutionalization, we have all these things that we're talking about that are required to say you're investable, as Marcy put it earlier. But returns, again, is becoming a big headache. So that would be the balancing act that I'd say. Certification, but in terms of driving it towards investability, returns then becomes a big discussion, at least from where I sit. Thank you.
Solo, so when Sam was speaking earlier in the panel, and you can disagree with him, you don't have to agree with him, even though he's your boss. He talked about demand for housing being there. You're very much at the forefront, I would say, of kind of the residential space now from an institutional level. But despite the demand being there, and that's very clear whether you're looking at from a rental perspective or a sale perspective, you have not seen platforms be able to scale up. And a lot of that is to do with the lack of institutionalization. How are you as Vida looking to bridge that gap going forward, given also what I'm sure that was part of the thinking when you did the transaction last year.
Thanks, Raghav. And this market has been said to be very fragmented. And that is largely because of the very low barriers to entry in the residential space. So previously, before the idea of platforms came up, is any person will put together a few million shillings, buy a parcel of land somewhere, and put up their own apartment block. And because of ease of getting approvals and what have you, that has become kind of the mainstay. So what institutional players are trying to do is to consolidate and actually increase these barriers to entry so that any institutional capital coming in is not afraid of managing bolting out and restarting the same thing the next day. And that has been the biggest challenge with attracting capital into platforms and hence institutionalizing. So what platforms like Vida we are trying to do is cutting this niche for ourselves and trying to build this route to market, this repeatability, operational excellence, the execution and trust in the market that then becomes the highest barrier to entry to anybody trying to come in. And that way we're able to pull in all the institutional capital globally into this particular space. Yeah.
Cool. For the audience, I know my friend Lunga, I don't know if he's here, was looking to involve the audience, but he just continued on for too long. I will be giving you the opportunity to ask some questions, so please do get ready with a couple. So just to stick to you, because I think it's important for everyone to maybe hear of a real life example, with what you've done with Vida. Right now you refer to also repeatability, right? And I think that is a very strong facet of an institutional platform where essentially you create a template that then can be repeated for success across different locations, right? Because real estate is essentially, you're not always going to be building a project in the same location, and that's exactly what you're doing. How are you, to just get into a little bit of the specifics, how are you trying to achieve that replicability? I think that'll be very interesting for the audience to hear about.
Okay, so the first thing is in the type of locations that we find ourselves in. So we pride ourselves for being players in mixed-use developments in large tracts of land and trying to be able to control what tends to happen in that particular area in terms of the product and importantly in terms of the amenities, because all our developments we try to have them very amenity rich. The second thing is the product. We want a studio in Mombasa and a studio in Nairobi to be the exact same thing, and you interacting with that product just from either the facade, the amenities, the quality of the product to be very relatable, and you can easily say that's a Vida product without it having to change from location to location, because then that complicates the scalability issue. You're not able to pull in the right economies of scale and bring down the pricing accordingly. So we are looking at it from a product, the kind of locations we find ourselves in, and that trust and ability to deliver when we said we will deliver. So that's what we're trying to do from a repeatability perspective.
So almost like creating a benchmark of quality. And quality can be not just in terms of the building specifications, but also that confidence that you'll deliver.
Exactly.
Right? Okay. Kavita, so again, taking on board from Solo, he's just talked about replicability. You obviously had this transaction with the Cube, right? From a developer's perspective, what were the learnings that you took on from the dialogue that you had with Timothy, where, what were the aspects that you saw that he was looking out for that would, that are going to be the aspects that you're going to be now replicating going forward for future developments?
Yeah. No, thanks, Raghav. It's a great question. And I think I learned so much from the transaction. But interestingly, the biggest point was that institutional capital mindset wasn't that different from family office mindset. We mirrored each other a lot. And the alignment that we found was really that we build for the long term. So we build for those future-proofed results. And as a family office, we really care about what you just talked about, Solomon: trust, dependability. What we deliver is what we said we would deliver at the time we said we would deliver it. And that is important from a stewardship perspective. So a big learning was that family office stewardship, and that hat that I wear, is very similar to the stewardship hat that Tim wears. So we had a lot of alignment and synergy there, which I think was foundational. The other part was, it was not a premeditated exit whatsoever. I wish I could credit myself with that vision from the outset, but it very much came about organically. But I believe that pathway to liquidity for any developer starts very early. So if quality is embedded from the outset when it comes to conceptualization, as you said, way above, a fancy tile or the bells and whistles, way beyond that. It's a human-centered design. It's what you deliver for your tenants that keep them with you through leasing cycles. It's what the execution really delivers for that end user. All of that quality mindset was actually the mindset that I wanted to deliver as a build to hold for our family office. And it mirrored what Tim needed in terms of his parameters as well. So that synergy was interesting. And I'd also say the other big component, and it's a softer point on a more technical panel, but it is something that cannot be discounted, is the true currency of trust and relationship that underpins everything that we do in business and in our personal lives, but it cannot be discounted. I think the collaboration that we had between Tim, myself, the team, Gen Africa it taught me so much about that respect, and it taught me so much about understanding what stakeholder management each side was going through and how to help and collaborate with each other rather than being adversarial. So that was a huge learning for me in terms of propagating the transaction. No slick presentation, no marketing billboards, no investment bankers in the middle. It was the two of us discussing and getting it over the line. Yeah.
Tim, so it seems that you were fortunate to find a meeting of the minds as far as Kavita is concerned. But given the access to opportunities that you probably have, it'd be interesting to hear if that's something that you're finding as a common thread now. Is there a viable secondary market? Because it's not just Innova, but many others that have been able to step up and build that level of trust, that confidence, that quality that she's spoken to.
It's a yes and a no. Let me justify both sides. I think I've looked at over 150 assets to land on that asset. So you can imagine how much time I've spent in terms of human resource with my team just to land on one asset. So in that regard, factually speaking, no. But a yes I think we're having more candid conversations. Majority of you can attest to that. We are becoming more candid on capital. I liked how Peter spoke about capital. We cannot necessarily compete with government securities, which is why we've all had an uphill task on fundraising. But we can reposition how we are marketing these portfolios to investors, because the challenge we're having is that balance between the deals are there, balancing what you earlier called a good investable asset, and then taking that to investors and trying to qualify that as the right investment opportunity. So we should increasingly see the growth of a secondary market, but as to whether it will be, the beginning is 1 year, 5 years, 15 years, depends on how candid of a conversation we can have.
Just to clarify, he's never looked at one of my assets, so he's not rejected me. Yeah.
Do you want to take questions? We've got an 8-minute clock.
Yeah, don't worry. I'm managing it. It's cool. It's okay. All right. Okay. Thank you. All right. No. I want to just give Anne a couple of minutes. Anne, we've talked a lot about what makes a viable platform, right? And you've heard from both Timothy and Kavita and Solo. From your perspective, as someone who typically lends money, what is it that you're looking for? And then we will open it up for 2 questions.
Thank you.
Maybe take one of the other.
You can hear me? Okay, thank you. I think it's the time pressure. So I think we've heard from developers, all who have had the pleasure to engage, interact with, including Raghav in his other life he deals industrial assets. So quality is key. So you can tell all quality assets will fill up way before a want of development that doesn't quite meet the kind of quality that we're looking for gets audience. We've also heard from the investor. He had to review, did you say 150 assets before you finally landed on one? And Kavita was not willing to let it go. 230 to be correct. So what do we do from a finance perspective? I think it's to bridge these 2 worlds. Firstly, there's huge demand. Developers will not get out of bed if there's no demand. Solomon has a platform, he's talked about it. It's on affordable housing, continuously developing. Is because there's a willing market, underserved, that's looking for that quality asset. So the end user is waiting. Raghav, the same, is doing grade A warehousing. He'll stop developing if we didn't need the asset, but suddenly the demand, the end demand is not fully satisfied. On the other hand, Timothy and his world of investors are looking for assets. So we, from a finance perspective and with our global expertise, is to connect the two. How do we enable developers produce sufficient stock, quality stock, do it at scale, do it quickly? How do we facilitate investors, augment their funds, boost your IRRs, make it faster? And from a relationship perspective, we also connect the 2 worlds. And you talked about our common friend, Lunga. I've seen he's there with the DC. He'll tell you some of the recent transactions he's closed in that regard. Thanks, Raghav.
Cool. Questions? There's no pressure. I know what I'm doing. Peter?
I'll be quick. Andrew from CBRE. Question. Nairobi is definitely maturing, but are you looking at the secondary markets? I know you have something outside any town or any city, but are you seeing investment into the secondary towns and cities?
My question is actually to Timothy. When I started fundraising in 2019, Timothy was on this other side there. he was a fund manager, and he gave me a really hard time. So my question is, now that you're on this side fundraising, number 1, when am I getting an apology email? But number 2, what would be your advice now to trustees and fund managers now that you've seen the kind of challenges that we both have going through? Yeah.
And one more for good measure. To be seen as a Democrat. Okay, you got the 2 questions?
Timothy, you want to take the first one? Or the second one? Sorry.
Yeah, I'll take the second one. I think the future lies in strategic partnerships. It's very hard to do this on your own. So we need to come together, see the hurdles, and see how to, jump over the hurdles together. That's the simple way that I look at it. Allow me to give you an apology now. I won't send an email. I think we need to, and Zamara Beryl said, they're doing this very well. We need to change the script in as far as how trustees look at diversification. That's the big problem. But the challenge we've also had is you have a lot of alternatives in the balance sheets, and quite a number have not really delivered. So even while we're trying to sell forward selling, we're already having to deal with some things in the past. So there's an element of education, but at the same time, it will not be as easy. I think we need to think through partnerships to see how then we can just improve returns slightly. I think that's the real solution.
On the first question with respect to the secondary cities, I don't know, Solo and Kavita, given that you're the developers, maybe you can answer that.
Okay. So on the residential space, Nairobi remains the core market for many developers. But as the economy grows, the devolution continues to mature. We are seeing the other major cities, Mombasa, Nakuru, Kisumu, coming up strongly. And it's just a matter of time before you start seeing either platforms growing from Nairobi to those particular cities, or new platforms coming up in those particular areas to address those typical markets, because their solutions tend to be very different because of the economies and how things tend to work out. Yeah.
I think, Solomon, you've covered it well. A real-life example is Coast. I think that's been a hot discussion recently. We have a development in Diani named Kai Diani, which really validated the market for us in terms of investor-led product. So we do see materially a huge jump in terms of the expectations at the coast, what is being delivered at the coast, and the pricing accordingly. Similar goes for Mombasa itself, Watamu, and other coastal cities. So it's an exciting shift that we're seeing, an exciting level of product that we're seeing coming into the market.
Any other questions? No? Oh, sorry. Shady? I still have a minute. And 1 minute. Yeah. I know.
All right. Yeah, thank you. Shadrach Mella from Air Consulting, and my question is to Timothy. You evaluated 150 potential properties for acquisition. And it's a conversation we've had before around just challenges. So we don't have a shortage of assets looking for buyers in the market, but deals are just not happening as frequently. So maybe you can just highlight, for the benefit of the audience, the key stumbling blocks that you see in some of these properties. I know pricing is an issue, but you can just highlight some key stumbling blocks or key issues that you encountered with those assets.
As it goes to the last question, let me be very quick. He's answered himself. Pricing misalignment, is it? Yeah.
Cool. Thank you, everyone. I want to, first of all, thank the panelists for a very engaging conversation. I think what we heard... You're cutting me off, okay. All right. With respect to the question about, what are we going to be looking for, let's say in 5 years' time, with respect to the institutionalization of real estate in East Africa, what I've heard from the team is, I would say, trust and track record. So knowing that, what you're getting for is what you've also paid for in terms of the quality of the asset, but also a level of reliability with respect to the partners that you're dealing with. And I think if we can really surmount those two key challenges, you're going to see a much more institutional real estate space in the next few years. Thank you.